Great, and thank you everyone. Welcome to this week's Insignio Speaker Series. I'm happy to be joined today with Erik Keller. Erik, who is a client portfolio manager for the global credit strategies over at Robeco. Erik, thank you for joining us this week.
Yeah, thank you.
Erik, so you've been an easy part of the market this year, the credit side. Obviously, it's been a tough year, not just for equity investors, but also for bond investors as well. I mean, I would say even more so of an anomaly, so much more difficult for bond investors. So maybe give us your quick sort of macro overview, your sort of 30,000 foot view as to how do you see the global credit markets as of today?
Yeah, well, indeed, as you said, we've seen quite some repricing in credit markets. And indeed, we've seen a lot of correlation between asset classes, so fixed income also declining alongside equities. Although I do think still, if you look at drawdowns, it's of course still less volatile than equity markets. But I think the positive side, the view that we see is that, with repricing, also valuations have improved. So we do see that with rising bond yields, but also the rising corporate bond spreads, that more pockets of the global credit market start to become more attractive in terms of valuations. And I think if you just look at yields, then we are able to get yields between 6 to 9% on different asset classes. So we do think, where at the start of the year we had low yields and they could only go one way. I think at this time it's a more balanced view, where we think at current levels, we are getting cautiously optimistic on some parts of the global credit market.
Okay, so obviously a lot of the repricing here has been driven by Fed action, but we've also seen repricing out of Europe, out of the Bank of England. Maybe give us a few thoughts on the credit markets in those spaces, in those countries.
Yeah, well, I would say that if you look at the year-to-date performance and spread widening, then we have seen more repricing in European markets. So definitely there, I think also because of the proximity to the crisis in Europe, we've seen corporates repricing more strongly than the US. So the US market has actually been doing quite well year to date. I think now also we see that the ECB is becoming more hawkish. They have also implemented their first jumbo hike. But we do actually think that specifically for European markets, a lot of the bad news has now been priced in. And so we do see pockets of value in the European credit markets, where in the US market, I would say if you look at ratios, we are not there yet. We probably would need to see a bit more repricing, at least to discount for more recession risk. So on the margin, we're slightly more constructive on European credit.
Okay. Let's switch back here to the United States. Right now, if you look at Fed funds futures, they're looking at a Fed terminal rate around 4.5%. That's a pretty sharp repricing from this week. I think we've had around 50 basis points of an increase this week alone. Obviously, that's been ratcheting up throughout the year. The common theme we've been hearing throughout the year is that every time there's a repricing on Fed funds expectations, they're like, okay, well, now we're there, and then we keep getting hit with higher, inflation prints, higher surprises, or at least inflation not coming down. Talk to us a little bit about what you're seeing in the inflation data. Obviously, we all know the CPI number came in disappointing this week, but we have seen other signs through other data sets telling us that inflation is peaking. I know investors are probably tired of hearing peak inflation theories and peak inflation theses, but give us your view on the inflationary landscape in the United States, where it's especially problematic.
Yeah, I mean, we would think it's too soon to call the peak of inflation. And of course, it's very difficult to predict this. From our fixed income team, we also look at, let's say, if inflation is broadening. And there we look at what we call sticky inflation. So we look at components like rental inflation, service inflation. And there we do see that the inflation is more broadening in the US. So it's not just about, let's say, high headline inflation and driven by energy and food prices, but also about the core inflation being more sticky. And that is, of course, an important indicator also for the Fed. Also, when you look at labor inflation, we do see that, we've seen wages in the lower income groups of the market increasing. We see it also there more broadening. And so the labor market has been also performing relatively well. And I think that's also we think that's also the reason why the Fed needs to keep on hiking and need to get to this neutral rate. because the underlying trends are also not that positive. And we think that's also a bit of a difference with Europe, where you do see that headline inflation is high, but actually core inflation is more muted. But also there with concerns, the central bank needs to hike rates. So, and what we're seeing is that, you do see now that markets are also pricing in more rate hikes for next year. So indeed, the terminal rate is important. We do think, the more sticky the inflation data is, the more tightening we would see. And the probability that then the economy will slow down quite significantly or even get into a recession will also increase. I think historically we've seen that in Fed hiking cycles, very often we'll see a recession down the line.
Yeah. I was in a meeting last week with former Fed Vice Chair Richard Clarida, and he admitted in a rare moment, I think, of institutional humility that the Fed's inflation forecasting models were way off. But he did mention that he thinks that some of that is attributable to the extraordinary circumstances of the pandemic and some of the accounting that's being done in that space that's not accurately capturing. But at the same time, while at the same time admitting that, he also said that if we could all, and this is for the listeners there, if we could take a theme from what, the big takeaway from Powell's speech, it's that failure is not an option. Basically hinting that the Fed is a lot more comfortable with the idea that investors think with inducing a recession in the economy as perhaps the only way to bring down inflation. Do you share that view?
Yeah, that's what we see. So we do think you do need some kind of demand destruction to really bring inflation down. So the Fed will need to tighten quite significantly. And there, so in that sense, the probability of a severe slowdown will increase. So we would agree with that scenario.
Okay. Is your view, let me ask you, this is a bit like idiosyncratic, but I would like to touch, because I think it's very much key to the outlook. Where is your view as to where the neutral rate of interest is in the economy in the United States?
Yeah, so we would look at 4.5%. So there you would indeed, and I think that the neutral terminal rate for Europe would be lower. So there we're more looking towards 2.5-3%. But this is where we would see that the impact of tightening will significantly slow down the economy. And of course, if you look at some parts of the economy, like the housing market, you're already starting to see this.
Right, and we actually share the view. I mean, we perhaps don't think it's that high, but we do think it's a lot higher than what the Fed certainly has said it has been, the neutral rate. If that's the case, though, don't you see the probability of a recession be less? I mean, because even at this rate, monetary policy is still accommodative, right? It won't be until the Fed gets to 4.5% that monetary policy will actually turn accommodative. Wouldn't that mean that the recession just gets further, not postponed, but that it comes later? Rather than some of the worst case scenarios that are being priced in right now of a recessionary environment?
Yeah, I mean, we would think that we would expect that recession to happen somewhere next year, and think with as said, we already see some kind of transmission mechanism there to certain parts of the economy. I mean, other parts, if you look at retail sales or labor market, are of course still resilient. Mm-hmm. But we do think that is more likely scenario for 2023. And in that sense, we do think that if you look at fixed income markets, certainly also in the US, you would need to see a bit further repricing to account for this recession scenario. Okay. Now, I guess let's get away a little bit from the more esoteric economic points. Let's go into some asset allocation themes, because we know that obviously to some degree from a multi-asset allocation, the move would be then to continue to drift into the equity side. But some investors are obviously constrained in that they have to be invested in bonds and they have to have a good portion of their portfolios in bonds. What do you recommend to fixed income investors? What are the most attractive places that you're seeing out there right now within the fixed income space, given where we are in the macro environment and where you're projecting the most likely scenario is in the future? Yeah, so we do think that the repricing that we've seen so far has mostly taken place on the investment grade and crossover market. So if you look at BB rated credits, investment grade credits, there we've seen already most of the repricing. And in these this type of fixed income asset classes, higher quality, There, of course, the risk of default, so in a recessionary scenario, is lower compared to lower quality credit. So there, we are actually getting more comfortable, and this is also an area where we've been increasing risk. So it's not that we are fully overweight risk in these portfolios, but we've gone from an underweight position in these, let's say, higher quality credits to now more a neutral, slightly overweight position. So we've reduced our underweight. And within that, we on the margin, as said, we do prefer to have an overweight in European credits, but there the focus is really on financials. So we're more cautious on the corporate sector, where we do see the impact of higher input inflation, the impact of a recession in Europe. But if we look at bank debt and subordinated bank debt, we do think there's a good value. We do see that
in Europe, right?
Europe, yes, yeah, in Europe. So and we do see that capitalizations of banks are solid in Europe. Also, when you look at provisions, and we think that they can withstand, a stronger slowdown in Europe. And we think that's valuation-wise interesting, and there we would prefer to be invested in subordinated bank and insurance debt.
Do you mind drilling down on that a bit on the perhaps country level? Because we are seeing a lot of dispersion in the economic data coming out of Europe. We're seeing places like Germany and Italy are being impacted much more from an inflationary standpoint than, say, Spain or France, who are less tethered to Russian gas flows. Any sort of care to drill down or give any nuance on that at the country level in Europe?
Yeah, I mean, where we are invested is well, we do have, I would say, banks across different countries. So Spanish banks, selected some German banks, but also banks in the UK, the Netherlands. A bit more lighter on Italian banks, I would say, although we do have some selective investments there as well. I think in general, what we've seen is that, coming out of COVID, a lot of governments have provided a lot of support to the SME sector. So although there's the impact of higher energy prices in some of these countries on the corporate side, there are also, state-backed guarantees for a lot of these SME sectors. So we actually do think that if these sectors face more problems, that there is a backstop also from these, state-backed loans that have been provided in COVID time. So we do think that actually, the loan losses for some of the banks will be lower than you might expect, perhaps in a more recessionary scenario. And I think, as bond investors, we look at the debt side of things, obviously. So, is there a risk that capital ratios will be hit? What does it mean in terms of your coupons that you will or will not receive? And there we think, when we look at these banks in these markets like Spain, selectively these few banks in Germany, UK, Netherlands, that we're not that concerned that we will be impacted. But it's also very much, of course, a bottom-up story. So we do stress tests. And we do look at the banks that we invest in to make sure that we indeed do see that these capital ratios are healthy. But we do think that these banks are able to withstand a slowdown. For some banks, we also see actually that they are able to benefit from a higher rate environment as well. So some of the banks in Spain, Italy, and Germany especially are more rate sensitive. So they're benefiting from this as well. And if we look at the earnings that we've seen so far from banks in Europe, it's been actually okay. So we are, in that sense, selective investments in Spain, Germany, UK, and the Netherlands.
Okay. Are you involved at all on the sovereign side in Europe or in the UK?
No. So no, in our credit portfolios, we do not take sovereign exposure. No, we have no explicit sovereign positions there.
Understood. Any other sort of market? Let's go look on a regional basis. How about China, Japan? We've seen obviously repricing in the renminbi as well. Care to comment on any Asian markets or markets outside the US or Europe that we've already discussed?
Yeah, and again, I take a bit the credit perspective, the corporate perspective. So we're more active so when we invest in emerging markets, it is primarily in corporate debt. And let's say in our portfolios where we can invest in emerging markets, we've actually been pretty light on Asia. So and there we prefer to be invested in the crossover space, in investment grade credits. There actually we think that a lot of valuations, compared to, for example, Europe, were not as compelling. So, if indeed you are more closer to a slowdown in China, we don't think you were compensated for the risks. So within EM, our focus has been a bit more on credits in South America, which have performed well. And we're basically waiting to see valuations to cheapen up a bit more in Asia before we would start to have, more exposure to Asian credits. But we do think at some point, we will. We are seeing more stimulus in China. You will see some kind of bottoming out, but that needs. We need to be. We've seen that reflected in prices as well.
Right. And I'd like to remind everyone that you can submit your questions either via the chat here directly to the participants or to me, and I'd be happy to share them with Erik here as soon as we maybe do another 5 more minutes of discussions. Erik, you mentioned Latin America as a region that you're looking at as well, where perhaps some spreads are more attractive. This region is obviously well known to us. It's sort of our core region, our core competency. Maybe walk us through some names. I know that obviously most Latin American central banks started their hiking cycles way ahead of the DM cycles. There's some indication that they're very much near the end here. We're also, but at the same time, Latin America is also in the midst of political uncertainty, especially in some of the major markets like Brazil. We still have let's say, and not finished business with the Constitutional Convention in Chile. We still don't have clarity with Colombia, with Argentina. I mean, so there's several key markets that there's a lot of uncertainty, a lot of risk premium built into them. Talk us a little bit about what's your thesis in Latin America and why are you seeing opportunities in the region?
Yeah, so again, we take it from the corporate perspective. There, obviously, in the way that if we invest in corporates in Latin America, we do always look at country risk as well, and we, as a credit investor, would need to see if it's a more risky country or we see more country risks arising. We would need to see more compensation when we invest in those markets. Otherwise, we would be more cautious in investing. But if you look at some of the basic industry players, for example, in Brazil or in Mexico, chemical companies, paper companies, these are typically companies also that have a more global client base, so they're not as domestically exposed to, let's say, a decline in demand domestically. So we're looking for more global companies being based in these markets, and they're actually, we think also because some of these countries are benefiting from commodity exports, that they are still well positioned to benefit from this. So we've had position in companies like, for example, Suzano in Brazil, and Mexico, or so chemical companies. We have been reducing risk as well there because what we've seen year to date is that in general these markets have performed quite well. We do see that also their valuations have become more expensive relative to other pockets of the global credit market. So slowly we've been in the portfolios, we're a bit more flexible, reducing risk there as well, and rotating that to other parts of the global credit market. But that has been a more higher conviction play year to date.
Okay. And what are the prospects for the region, let's say over the next 6 or 12 months?
Yeah, now, as you said, we do see also more political risks arising. So we don't think that currently valuations across the board are really compensating you for this. So we do still have some positions there, but it has been reduced compared to the start of the year. We do think with these volatility, potential more volatility in these markets, we will be a bit more cautious.
Okay. All right. I have some questions here that were sent to me directly, Erik. So I'm going to start reading them out. Are you only investing in dollar bonds?
No, we're global investors. So we invest in emerging markets, which is mostly dollar bonds, but we are also active investors in Europe. So there we also invest in euro bonds, and that's at least where we have the flexibility to allocate globally. And as said, we on the margin are currently overweight in Europe.
This is a question that I'll do a follow on. Do you hedge out that currency risk or you keep it?
No, we hedge out currency risk. So in our portfolios, the focus is really on generating performance for our credit selection. We do not want to take explicit, rate views or currency risks in our credit portfolios. Okay,
so you're hedging out interest rate and currency risk. You're just solely focused on credit.
Yes.
Okay, understood. I have another question here on the U.S. municipal bond market. I know that's a market that recently has sort of gathered some attention. Some of the spreads there are, attractive considering the balance sheets of some of the states. I know this may be out of your wheelhouse, but I will chance it and throw the question out there just in case.
Yeah, no, in all fairness, it's indeed a bit out of our expertise, so we don't really invest in that market.
Okay. I have another question here on this might be as well, but I'll chance it as well. ABS markets, leverage loans, these types of sectors. Are you looking at those, or do you have any opinion on those?
Yeah, so the way we use the ABS market is more to we prefer, and there actually we focus more on we use ABS as a way to de-risk portfolios. So we prefer to invest in high quality covered bonds, AAA ABS, very liquid. We are not really active in the let's say US MBS market, so that's not really a return driver for the portfolios. We've been adding to, let's say, some more higher quality credit as well, and that's a bit of a technical story, but we've seen, for example, in Europe that swap spreads have widened quite a bit. So it is a way to get a bit more exposure via higher quality credits to more elevated swap spreads there.
Okay. Can you walk us through your investment process? How do you decide to take on a bond or to buy a bond? Basically take on that credit risk. You see a mispricing there. Maybe walk us through what are the sort of the initial steps through the investment process, and also how do you decide whether to keep it, sell it, or buy some more?
Yeah, so we're really value-driven investors. So the way we look at the universe is that we want to bottom-up identify in certain sectors. The way we do our fundamental analysis is that we look at credits given their ratings. So we take the external ratings as an input. So let's say BB rated credit or BBB rated credit. We do our fundamental analysis, and so we want to see if we agree with that external rating or not. And then we look separately if we then look at spread levels compared to similar rated peers in the industry, if you're seeing more value. So we look at it versus peers, but also versus the global index that we use. And if you see that the spread levels more than compensate us for the credit risk, then we would be willing to invest. And there we look at ratios versus the index versus similar rated peers. And once we see that undervaluation has normalized, we will sell. So really, what we see very actively in crossover markets, in investment grade markets, is a tendency to mean revert. So we want to identify basically pockets of the market that are oversold, identify bonds that are cheap given similar rated bonds versus the index. Invest in these bonds if you're comfortable with the underlying credit profile, and then waiting for this undervaluation to mean revert. So we, in that sense, also take a bit of a contrarian view. And then we have a top-down view as well, where we do a quarterly assessment of where are we in the economic cycle, the credit cycle, and that basically drives the overall risk-taking in the portfolios. So, for example, at the start of the year, we had a very defensive positioning. We were underweight risk. And as said, in the more higher quality portfolios, the crossover portfolios, we've been reducing the underweights to modest overweight risks. In our dedicated high yield strategies, we're still slightly underweight neutral risk, and that is really driven by our top-down view.
Okay. How about another question here? What do you think about Pemex?
Well, I cannot really comment on this specific company, but I think in general we like some of the construction chemical companies in some of the Latin American markets. But as said, we have been also reducing risk there as well.
Okay, I have your question on the UK and the corporates there. Any comments on that?
Yeah, I mean, not currently. So we as said, we like some of the UK banks, but it's not, we don't drive the position based on a country view. So we've not seen, you do see, of course, also in the UK, potential slowdown. There we again focus mostly on some of the larger banks in the UK, which we think offer attractive value, but not a really explicit country view that we implement in the credit portfolios. Okay.
And finally here, I'm going to end it with what's your expectation, I guess, for the Feds? Let me just rephrase this. Do you think that rates will be cut next year, they'll stay the same, or they'll be even higher than what the current market is pricing in right now?
Yeah, that's a very... I mean, definitely we do not think that they will be cut next year. We do think that the Fed will be inclined to hike rates and keep rates at a high level until they see really evidence that the inflation comes down. I think will they hike more than is currently priced in? That is really going to be data dependent. So what do we see in terms of inflation data coming in for the next couple of months? If that continues to be sticky or disappoint, then we might see further, upward repricing in Fed markets. And otherwise, and that's also what we've seen, a couple of months ago, is that some of these Fed hikes will be priced out if we see that already this year inflation data is rolling over.
Right. Excellent. Garrick, thank you so much for your time
Thank
today.
you.
We really appreciate you being here with us, and thank you for taking some of these very candid questions and answering them in the most candid way possible, given the constraints as well, right? So thank you very much for joining us.
Thanks a lot.
Thank you. Thank you, everyone, for joining us this week. We'll be back again next Thursday with our next guest. Thank you. Have a great week, everyone.